Welcome to Good Money Guide. Today we're talking to Christopher Forbes, who's the head of CMC Invest in Singapore. Now, CMC Invest is CMC Markets, offering for longer term investors who are looking for capital growth instead of just speculation. It recently launched in Singapore, so we're going to have a chat with Christopher about what CMC Invest offers Singaporean investors, find out a little bit about him and the Singaporean market in general. So Christopher, thank you very much for joining us.
Good evening or good morning to you and good evening to me. Thanks
good morning
for having me on, Richard.
No, it's a pleasure. So let's just start with, how's business with CMC Invest over in Singapore? How long have you going? How long have you been going, and how's the market over there?
So we've been going for about 3 days now since launch.
Right.
it's been hectic. We literally launched on the 25th. It's been a whirlwind 16 months since I've been here. So I joined to lead the rollout or the development. We had to build the whole thing, get our licenses, build a team, get the offices, and effectively launch the Invest platform. So we have an MVP out, which is effectively ETFs, shares, REITs across 15 markets. And that will go to about 20 markets. Plus, we're working on a wealth management platform, an OTC options platform or fractional options, and then we'll start to add all the features such as multi-currency, etc.
Okay.
As we roll out. And so we've built in 15 months a mobile app, a desktop, the 15 markets. So in that sense, it's been a pretty good development. It's a very tough market to launch in, though. We're finding out now it's incredibly crowded, very sophisticated tech from the US and Chinese players predominantly. Although, in fairness to Singapore, it's been a very well served market by the likes of Philips and KGI and even CIMB for a long time. It's not a young or new market in that sense. It's pretty well established. So actually. Sorry, after you.
No, I was just going to say, my first job as a stockbroker was working for Philips Securities.
Oh yeah, well they're great here. I mean,
with Mr. Lim,
they really are.
And their poems system. I remember it. It was
exactly. So poems is still here.
That was decades ago. But no, I remember Mr. Lim coming over. It was a big deal. But anyway, so that's good news. So 3 days, you got an MVP going. Is that based on CMC Markets technology or the CMC Invest technology that's over in the UK?
No, the markets
from scratch.
No, it's a good question because the Invest technology in the UK is a completely different system. Literally chalk and cheese. We've not touched markets. We're not actually allowed to touch anything in the market side. So it's a completely different legal entity, different platform, different team, different people, different tech. We're not even allowed to share email addresses from them, just purely because it's a completely different PDPA and GDPR rules nowadays. So that's quite strict here, especially in Singapore. And what we've taken is some of the kit from the Australian Invest platform, which is using GBST, which is FNZ, and because we are a CHESS participant in Australia on the ASX. And then we've had to rebuild and re-architect effectively a ledgering system, a cash system. We've taken a new banking partner in JP Morgan in Singapore. We've got our own local custody in BNP. We had to build all of that, and including we have to offer by law an MFA. So we had to integrate ForgeRock, and we have in Singapore we have biometrics, for example, but in Australia we're not allowed biometrics. So we had to really change everything from Australia. We've built a new front end platform for a new onboarding journey via SingPass. To be honest, it's not my background. It's been a baptism of fire, but it's been fun. I've learned a lot. I've probably made 10,000 mistakes, but it's been a journey. And we're 3 days into the live, getting customers and servicing them. So it's fun now. This is the fun part.
It's an interesting point, actually, because I always wondered, when I heard that CMC Invest was coming out, out of CMC Markets, I thought, oh, brilliant, they're going to do a sort of Saxo or an interactive and just plug investing onto the trading platform. And I remember when I spoke to Albert, he was saying, no, we've gone completely from scratch. And actually, I think it's a really nice approach, because I speak to a lot of people who are trying to build global brokerages, and I think one of the mistakes they make is they try and serve themselves first rather than customers. So, if you take eToro as an example, they just want a dollar-based account, and they want everyone trading in dollars and just going, and there's no SIPs and no ISAs, and we'll get onto what sort of accounts you offer Singaporean investors in a minute. But I think it's I think it's a really great approach, servicing a local market, specifically with a specific product. So actually, on that, how can Singaporean investors invest through CMC Invest? Obviously in the UK we've got our general investment account, SIPs for pensions, which are tax efficient, and then ISAs for some fairly tax efficient investing. In the UK, will you be offering the same sort of account types for Singaporean investors, and really how can they invest through you guys?
So we're, let's say, lucky in Singapore where we don't have capital gains tax and we don't have withholding tax.
Right.
So a lot of the things like the SIPs and the ISAs are designed to be tax efficient. Well, we don't have those taxation rules in Singapore. So in that sense, we don't have those wrappers, if we can call them wrappers. What we do have here is a thing called CPF, and within CPF, which is effectively like a pension, within CPF, it's split into 3 buckets. One of those main buckets is something called SRS. That is where you get some discretion to play around with your finances now. And traditionally, Singaporeans have just left it in cash or given it back to the government. And let's call a spade a spade. We all know it's GIC here in Singapore, the pension fund, that they effectively guarantee you, say, 3 to 3.5% yield. And that's generally what people do. It's quite a risk-averse country in that sense. So if you look at the stock market, it's very representative of an old economy and old thinking. So you've got banks, brokers, real estate, and REITs are the market. There's one telco, one utility company, again, sort of government, quasi-government owned and state-backed. So in that sense, the stock market is fairly limited to what you can invest into, and the risk appetite, it's not been huge. However, I am seeing a huge shift, and it's probably more because I'm aware of it now in this role, but I noticed it during COVID as well. Risk appetite for options, especially US options, of just buying premium, selling premium, is huge. And we can talk about TD Ameritrade. There seems to be a pretty strong player here, or a Moomoo in their options market. And they've just left Singapore, which is a shame, actually. The other thing they're really seeing is a huge, diversification into US growth and effectively ETF investing.
Yeah.
There's a lot of asset managers in Singapore, wealth managers, but they're effectively fighting for that same 2 and 20 model, which I think is sort of dead now. Yeah. And that ETF space is really or passive investing really growing, and platforms like ours, where we're incredibly cheap and incredibly transparent. It's actually a great time to be looking at ETFs, to be honest, and saving for the long term and compounding.
Yeah, I think there's there's 2 things to look at, really. Transparency and costs, and transparency as in, are they a well capitalized firm, and are you being charged what you say? It's interesting you brought up ETFs and passive investing, and in particular a sort of move towards options and the US growth markets. I don't want to simplify the whole process of investing, but do you think that's a result of social media? Because I don't do a huge amount on social, but obviously, I'm not on social media. I've tried it a couple of times. I can't do it. But obviously, I use it for research and just to see what's going on. And every time I flick on any social media app, all I see is people saying you should buy an S&P tracker. And there's obviously a lot of social around options trading. GameStop, we've got the film Dumb Money coming out soon, which I think will be really interesting. I think that'll get a lot more people interested in options again. So do you think social media, obviously sophisticated and established investors know what they're doing, but do you think social media is sort of pushing people towards these products, some for good, some for bad?
Yeah, completely. Yeah, you're dead right. I think social media is doing it. I think some of the messaging they're saying is there's merit behind it and fact behind it, though. Most retail investors, just stock pick, underperform professional investors. However, most retail investors who just buy an ETF will outperform the market, or not the market, but outperform active managers. And to be honest, when you don't have the level of sophistication or time, and I think time is a big factor here, buying some sort of diversified MSCI World or S&P tracker is not a bad outcome. And the expense of the TER or the management fees in those things are anything from 10 to 24, 25 basis points nowadays at that level. It's pretty good versus a 2% fee to a unit trust. And then you have to pay an advisor on top of that, say 1%. So that 3%, you're looking, if you have a diversified fund, you're looking for 6-7% returns, maybe a little bit less in dollars. And if you pay away 3% of that to an advisor, I mean, you're paying away 50% of your upside for 100% of the risk, 100% of the capital. Doesn't seem like a good risk reward trade to me at that point. Yeah. So is there merit in using ETFs? 100%. Is it perfect? No, I don't think so. But there's probably a happy medium somewhere. And I think that's likely to be a sort of diversified ETF portfolio.
Okay. And where does CMC Invest sit within that market? Do you cater heavily to that? And really, what's the appetite for investing? I know we talked about sort of REITs and ETFs before, but what's the appetite for Singaporean investors? Do they like local stocks and US stocks? And what sort of range of markets do you guys offer them?
So we offer Singapore, and it's largely most of the model we offer, or all of the model we do offer, is that we give a couple of trades per month in Singapore for free. We don't charge a platform fee or custody. There's no FX. We don't make anything on that. It literally costs us money to service that client.
So how do you make money?
That's
the key question.
If you trade in the US, that's the only way we make money, and just on the FX, and we publish that FX spread, and it's fixed. We don't make anything beyond that. It's a fully funded model. There's no leverage. We don't make on custody. We don't make on safekeep. We don't charge settlement fees. We actually absorb some of your taxes as well. If you trade in Hong Kong, there are 3 taxes. We pay 2 of them on your behalf. So honestly, the model is designed to be, one, transparent, because we tell you exactly what we're doing. We get criticized on the internet for it, which is quite interesting, because they say, "Oh, you're very expensive." But if you actually do the sum of the parts on our pricing model, and actually Seedly and SingSaver have done that on our behalf, actually, we're probably the cheapest, if not the cheapest. Up until about $900, I believe it is, we're the cheapest. Just as you get to $900, Interactive Brokers becomes on par and then slightly better. Thereafter, it's us ourselves and Interactive Brokers by far. How do we do that? We have scale. It's a 35-year-old business with 1.4 million customers, and we have a huge book in the UK and Australia trading stocks. So we get a lot of synergies through that. We don't touch the CFD platform, but in years to come, if we can integrate the CFD in the back end, just the settlement, not the actual risk and the parameters and etc., but just the settlement alone on the custody, there's huge synergies for us again. So that's the reason we can do that.
Yeah.
How will we make money going forwards? Once we launch wealth management, that's one way. We'll look to monetize that through a monthly subscription model. And same with options. Once we list our options product, we'll make money through the trading of options. But again, most of the options will be free for our clients. So it's a very different model. Do I believe that we will have stock pickers or ETF pickers? To come back to your earlier point, I think we'll always have people that think they can beat the market and stock pick, and it's more interesting, and they do analysis, and we offer trading view on our platform, so people can do technical analysis. We have the fundamental data for Morningstar, where you can pull reports and look at PE ratios, price to cash flow ratios, price to earnings, whatever ratios you want. It doesn't do a DCF for you, but that will be stage 2, where you can effectively pull like a basic model off. Yeah. So that's all coming. I still think that the vast majority will use ETFs.
Yeah.
The future generation.
Yeah, but I think it's a good in to get started investing.
For
You know,
sure.
nobody starts off as a sophisticated investor, and I think during lockdown in particular, it was a good example of how not to do it. You know, everybody started in crypto, and then all of a sudden realized that investing is a little bit harder than that. So now there's almost a reversion to safety, a sort of flight to the safety and diversity of ETFs. And it sounds as though that's where you're going with your platform. You're starting off sort of nice and simple, get people in, and then gradually add the more complex products as people's portfolio goes. Because actually, you know, even though they are derivatives and speculative tools, options and CFDs, you know, the purpose of them really is to hedge and help you manage your portfolio better. So I suppose it makes sense to add those products.
Yep. I mean, interestingly, one of the first platforms we built when I joined was the crypto platform. We actually built the crypto platform before the stocks platform was ready, but we've not launched it, and we're not allowed to launch it for regulatory reasons. We don't have a license yet in Singapore. No brokers do, in fact, other than DBS. They've segregated it all just for crypto players. But interestingly, that was actually a lot easier to build.
Yeah, and how is well, I suppose it is, because there's not that sort of legacy custody that you have to deal with. How is the appetite for crypto in Singapore?
It was enormous. And there was a series of scandals in Singapore, generally fraud related or business model related, not the businesses themselves, but the business models or the actors behind them. It was just, you know, there's 4 in particular, fairly well published and named, but I think they've created a lot of loss of confidence and crisis. Plus, let's face it, people actually lost money in those incidents as well. I think that's left a very sour taste with retail, but also with the regulator. Regulators, you know, the MAS is not one to mess with.
Okay. And so obviously you've been in this business for a while. I was looking, you know, you've been a trader, managed a family office, and now you're running now you're running a brokerage. It's always nice to get some insights from you. I mean, obviously you're only 3 days old. You know, CMC Invest is only 3 days old. So you can't give us that many insights into how your customers trade and invest or something. But you know, if there's something you could say to investors in Singapore that would, you know, help them make more of their money or be better investors, you know, for 2 points really, you know, when they're just starting out and when they become more sophisticated, what would you say to investors to help them out?
So, I mean, let's use some cliches because they're always easier to go with. Never chase a hot stock. So like meme stocks, if it's on Reddit, I generally avoid it. If it's on YouTube, generally avoid it. I generally avoid following financial experts. My old boss used to say to me, Chris, if you ever want to learn how to lose money, ask an expert. and I still think that's true today. So I think a lot of it is do your own research, do your own analysis. I think valuations do matter, but I think technical analysis matters more personally. I'm a huge technical analyst fan. So, and again, and part of the reason we integrated TradingView charts on our platform is because I genuinely love technical analysis. I think it's useful for timing entries and exits. It won't tell you what to buy, but it will tell you when to buy. And I think that's an important distinction. To some extent, it doesn't matter what you buy, but it does matter when, every time. And so that's something I definitely recommend people to understand. The skill of a good investor is to buy fear and sell exuberance. But what retail investors have historically always done when picking stocks is the opposite. You're always chasing the hot thing. And the reality is your job as an investor is to know when it's hot and actually just stay clear. And I think Warren Buffett probably has done that the best. And even Buffett, if you exclude that first 10, 15 years from his investing career, actually the back end of the last 20 years, he's just performed or underperformed the S&P, which is why I come back to, you know, I don't think there's a lot of alpha to be had in single stock picking at the sort of retail level. I think unless you're a sophisticated hedge fund, I generally just stay away from it. It's probably my best advice. The last thing I would say is I generally buy things I know and use or like. And let's say, for example, I have an Apple phone. If I just bought things I know and like, I would probably have done quite well with myself. And that includes what TV I have, what clothes I wear. Let's say Lululemon as an example. If you look at what airline do I use? Well, I like to travel on a certain airline. And I know it sounds silly, but those things generally play out quite nicely. Not always, but I know it. I can roughly in the back of my head say, well, it will cost X to get on this flight, and the cost of running this flight are Y, and therefore net profit is likely to be X, and you can model that out quite easily in your head. If it's when you start going off on tangents about buying rocket ships and the next hot meme stock, there's one in Asia right now, sort of a private equity favorite and potentially coming to market, which is an electronic fishing company, electronic fishery.
Yeah.
And again, I asked a few of the guys, I was at this conference, what's the moat of the business? Like, why is it so valuable? Like, can it just be replicated? Oh yeah, it's literally like just electronic fishing. I was like, so why is it $1.5 billion?
Yeah.
Oh, the first mover, it's got this, it's got that. And it just smelt to me of the next meme stock.
Yeah.
And it's kind of thing that I avoid.
Yeah, but also, I mean, valuations when companies come to market, particularly in that sphere, when there's a lot of VC money behind them and they just want to ramp it up and get out. I think they're great stories to tell, but I think IPOs, they used to be a fantastic market for stagging and value plays, but now a lot of them I just think are massively overhyped. Obviously, Arm did quite well, but a lot of the recent ones like VinFast.
They've done, I agree. But if you look at, okay, let's bring that back to our industry. There was a time, especially in Singapore, but also in the UK, where you could effectively raise PowerPoint money, if we can call it that, right? And you do Series A, B, blah, blah, blah. You build proof of concept and you raise C, and you really raise at a big valuation. So in the UK, Nutmeg's a great example. They sold for 700 million, I believe, to JPM, who are probably taking a huge write-off. The same in Singapore, where there's a couple of companies who've successfully raised money. They've gone out to do the land grab through marketing. But it's very hard to monetize that. And what you're seeing in this downturn we've seen, or at least the market, to raise money now at 6-7% interest rates, when any analyst does a DCF on that, well, the cost of capital is no longer zero. So those business models, and a lot of them went into fintech and SaaS, and especially in Singapore, it was going to be very interesting to see how do they raise the next round, or how do they monetize. And I certainly noticed when we were coming to market, a lot of people just turned off their marketing dollars because that's where the big burn was. I'm absolutely convinced there's going to be consolidation.
Yeah, do you know, I've seen it a lot actually, just in the way we interact with our customers. Because obviously, I mean, you look at Free Trade, for example, they had their latest round of funding, gave them a real dent in their valuation. And these things are great when everybody wants to invest, but all of a sudden, if people just find out that all they need to do is buy an ETF, then all of a sudden, the influx isn't there, and the growth dwindles, and it's all of a sudden, if you don't raise any money, you're going to run out of money, and then you're going to go out of business. Which is why I've always one of the questions we always ask, why I asked you, how are you going to make money? I suppose the difference between you guys and investment apps like Doddle, who are backed by AJ Bell, is that you've got the backing of CMC Markets, but the independent apps who are living and dying on their growth, when actually they don't have a product that charges customers that much money. And in fact, a lot of people monetize their business in the same way as you guys, in that everybody wants to invest in the US. So, we'll make our money on the FX, but so
completely
saturation. And actually that just our final point, which we were discussing earlier actually, is where CMC Invest sits within the Singaporean market. Because one of the things you were saying was that the technology and the sophistication of platforms and apps out in Singapore, you think it is better than what we've got in the UK
by miles. Miles.
So let's just touch on that. Why is Singapore so far ahead? Is it for regulatory reasons, or you just got better tech, or and obviously you've got that smaller population, haven't you? Sort of 5 million versus 60. But as you were saying earlier, it's a wealthy, sophisticated population, which is almost the dream client base. It's almost though you've got loads of those 10%ers and not much of the 90%ers, if you're on that sort of 1090 10/90 split. So why do you think Singapore's got such a sophisticated offering versus the rest of the market?
So I think one is proximity to Asia. So there's a lot of great coders in Vietnam, Bangladesh, India, China. They're really strong coders or engineers, and I think that's a big pool of talent at a good price point, because that cost of building a platform is incredibly expensive. Servicing that in Singapore, you'd say, oh, it's cheap. It's actually not. Manpower or average wage in Singapore versus the UK is actually higher in Singapore. So it's not a cost of the servicing. What I think Singapore does incredibly well is take technology from, and I think the two main players are China and the US. So there's a bunch of great US tech SaaS players here. And where Singapore had effectively skipped a generation, it's almost like skipped the industrial revolution. We don't have that huge infrastructure problem like India's been doing for the last 5-10 years. It effectively missed the old 65-bit dial-up and went straight to broadband fiber and satellites. And that's a huge benefit for technology. And with the way I look at how we have multi-asset, multi-currency, the way they're built and how simple they're built here, it's far better than the tech I see in the UK. Different tech, but interestingly, in Singapore, you have to serve for multi ethnicity and cultures. Whereas in the UK, I think you can get away slightly where you're serving a UK market, you're not serving a European market. So I think the way they build and design and do the customer journey mapping is slightly different. And at the same time, I think there's still a big fight to get business away from the banks, and they've still got the banks in Singapore are enormous. And I think what I mentioned earlier, one, maybe two of those banks' market cap is bigger than all of the UK banks put together, and yet you have 11 times the size of the population. Well, and those structural realities, they play into how competitive you have to be in Singapore. Because if you're not competitive, then you're effectively bankrupt and gone. And so everyone here is pretty sharp. I think there's a lot of different niches here. So what I'm seeing in Singapore is you've got 2 or 3 years ago this enormous rush for wealth tech, robo advisory. 4 or 5 big players came out, backed by all of the big banks. The banks didn't go after them themselves. They went and backed the private equity companies to build them. And there's a few of them, the Sifes, the Endowas, the Stashaways, Money-Owl. We're seeing some of those fall away. And we're seeing some of those not make it through this latest round of financing that we discussed earlier. So that's interesting. We then saw a huge influx recently, the last 12, 18 months, of Hong Kong-based brokers. We also saw that same influx of Hong Kong-based people coming to Singapore. I can't say too much about the Chinese regime, but effectively escaping Hong Kong for whatever reason. Okay. And so you're seeing that. And currently what we're seeing, and I would say we're 3 days old, is we're now seeing TD Ameritrade, who yesterday exited the Singapore market on a retail basis. And I'm convinced others will follow, where that retail level, servicing retail, is becoming very expensive. It's becoming a regulatory, it's not a nightmare, but it's certainly cumbersome. And where it's so competitive now, that race to zero is starting to show who has scale and who doesn't. And where marketing dollars have gone, I think the USPs really have to be around servicing that top 1 to 10%. And you hit the nail on the head. Singapore has that in abundance. And so a lot of the players are gravitating to that 1 to 10% now. But really the CFD players, the private banks, the big banks, and people like CMC, where we have a good reputation for trust and transparency, will win that fight. I think there'll be a few more casualties in the next 12 months as a result, though.
Good. Well, look, we'll catch up in a few months when you've when you've onboarded a few more customers and you've seen you've seen what they've done and how revenue's doing. Just on the sort of light-hearted competition nature of it all, you obviously you're saying about the tech over in Singapore. Do you have little internal leagues with the other regions, UK and Australia and Europe, about who's building the best tech, who's got the best conversion rates, whose marketing dollars spend is most effective. I think that'd be quite interesting to see. Is there anything like that going on?
I'd better not say too much. Yes is the answer.
Yeah.
I won't say what they are.
Yeah. Well, you can't
Yeah,
tell
we
us
do
who's
on
winning.
tech and people and spend, and it's all very topical.
Yeah.
I
No, it's
can't say
interesting,
too much, but yes, but friendly rivalry in a good way. And inter office, there's 12 offices in the group, and sure, we all look at our numbers on the CFD and invest side for sure.
Yeah.
But it
It's fun.
would be remiss of us not to have some sort of friendly competition.
Yeah, it's funny because I think I mean,
It's more fun.
Investing's a wonderful thing. I've always said, like when in our world, the sort of price comparison world, like you like car insurance, credit cards, like you don't really care. You just go on and buy something and then you forget about it. But with investing, it's a sort of relationship over 30 years. So as well as it being a sort of massive relationship business, it's also a massive marketing machine that's almost won on conversion rates. It's obviously there's a relationship for the big customers, but then there's the aspects of everybody selling the same biscuits, which is a phrase I use all the time. If everybody's just investing in S&P ETFs, it's like, we're all selling the same biscuits. So how are you doing it better than anyone else? So the win is almost, how do you convert better? How do you service your clients better? But the initial, the real measure is how do you convert better? Maybe we'll do a sort of separate chat about marketing in finance and the various conversion rates to look at, because I could talk endlessly about it, but it's
but it really matters. Like, we've spent a lot of time, and I don't think we're perfect at it, if I'm being blunt. But I think that customer acquisition retention is crucial, right? Because you're constantly trying to drive your CPA down, your customer acquisition cost. Secondly, to that funnel of effectively acquisition, fund, trade, and effectively lose, when that retention piece is the important part. What is their onboarding journey like? What is their trading journey like? And so we do a lot of heat mapping, and we understand where they look on pages, what specific things do they look on, and we can see that, and we can heat map it quite quickly. So we know, okay, fine, everyone likes to look at insights page, or everyone's looking at the Tesla earnings report. So it's quite easy to see those trends. But you're noticing customer emerging trends around ESG. I don't even think it's emerging. It's pretty well entrenched now. But people are demanding from us, I want more ESG data. I want more carbon. Every time I trade an Apple stock, I want to have a carbon offset token attached to my platform. It's not a bad idea, but that's the trend, and it's going that way. And it's some brokers are ahead of us in there. So we now got to play catch up, I think.
You notice actually that the brokers that do well and the brokers that ride a trend really well are the ones that give people what they want immediately. Like if you build something for you and try and give it to customers, they're generally not interested. But if you can tell through your analytics and trends what customers want and give it to them quickly, and I think most important, easily as well, if there's any
simplicity.
If there's any sort of trip up or delay in the account opening process or anything, you just forget about it. People just give up and move on, don't they? But I think that's the real democratization.
You've lost them. You've just
is ease.
Completely. We've got customers asking us, every time I trade, I would like to donate X% of that basis points of that commission dollar into charities.
So let's just
build it.
So let's just talk about that as a final point. Is there one thing? Obviously, you've just said something there, but is there one thing where you've been interacting with a customer and they've gone, do you know what? I'd really like this, and then you've gone, yeah, perfect. We'll do it.
So one thing that we are building at the moment, which not many people have, is fractional options or OTC options. Almost no one has it. People have fractional shares, and crypto is fractional anyway. But fractional options, if you bought like a at the money Tesla call, for example, that strike is around $20,000, $25,000. So you're paying, say, 5-10% premium. You're looking at 4,000 to 5,000, or let's say 4,000 premium up front. It's quite a lot of money for people. So realistically, we've had the feedback, and we've now designed and built, and we've hired the team, and they've launched their MVP internally to staff, and we're going to iterate it to clients. But we can now trade $1 options on Tesla. So
Excellent.
Stuff like that, CMC is really pioneering.
Yeah.
I don't think many other brokers do that at all.
Yeah.
But that's direct feedback from customers that we'll be launching into the UK, Australia, and Singapore, and a few other markets pretty soon.
That's really interesting. That's fractional options. That's one to watch. I was looking at our search analytics the other day, actually, and one phrase that keeps on popping up is it worth buying just one Tesla share? So I think particularly within the Tesla market, there's a real appetite for fractional shares within Tesla, because it goes back to what you say, actually. And just my final point as well is my daughter, I've made her join the investing club at school, and it's the teacher's gone, what shares do you want to invest in? And it's all Adidas, Nike, Apple. There's a great index worth following, actually, based on children investing. It's called the Pocket Money Index by Rooster Money. It's a pocket money app out here, and they do some analysis on, so they can see obviously what children spend their money on the app, and how the share prices correlate to brand awareness and that sort of thing. So it's there's a huge appetite for fractional shares and recognized brands. But anyway, I think we're pretty much out of time. So Christopher, look, it'd be great to catch up with you again in the future, when you guys have been going a little bit longer. If you've got new products, do come back to us and let us know about them. For anyone out there who's used CMC Invest out in Singapore, we'll have a review up on the website where you guys can leave your feedback. I'm not sure if you've seen, we obviously do our annual awards every year, and we may do some international ones. So it would be great to get some of your client feedback on the site. It always helps us out. We do everything on a relative basis, so it's what you think of CMC Invest versus your competitors. So Christopher, thank you very much.
Would love to.
Much for joining us.
Thank you very much. Thank you very much for having me as well. Have a wonderful morning.
You too.